9.57 million federal student loan borrowers were in default as of March 31st, 2026. Now the government says management of roughly $180 billion in defaulted loans will begin moving from the Department of Education to the Treasury Department. That sounds like an administrative reshuffle. It is not. Because Treasury is not an education agency. It operates federal payment and debt collection infrastructure that can redirect eligible federal payments. And when millions of borrowers move from missed payments into default, the pressure does not disappear. It moves from a student loan account to a credit report to a paycheck and eventually into the wider economy. So let us map the move. First, delinquency is not the same as default. A federal loan becomes delinquent when a required payment is missed. After extended non-payment, generally around 270 days, the loan can enter default. That distinction matters because the consequences escalate. Before default, a borrower may still have options through a servicer. After default, federal law allows the government to use collection tools such as treasury offsets and administrative wage garnishment without first obtaining a court judgment, subject to notice and procedural requirements. The Treasury Offset Program can redirect certain federal payments, including tax refunds. Administrative wage garnishment can take up to 15% of disposable pay after the required notice and process. Not every defaulted borrower is being garnished today. But default changes what the government is legally able to do. Now look at the scale. According to Department of Education portfolio data reported for March 31st, 2026, about 9.57 million borrowers were already in default. Another 2.97 million were between 30 and 270 days delinquent. That does not mean all 12.5 million will default, but it creates a very large pipeline of financial stress. And this pipeline appeared after an unusual period. During the pandemic, required payments and involuntary collections on many federal student loans were paused. Payments later resumed, and the temporary on-ramp that shielded borrowers from credit reporting consequences ended. Collection and transfer policies have continued to change, so the important distinction is between tools the government is legally allowed to use and actions currently being implemented. The New York Federal Reserve's household credit data shows exceptional stress in student loans. By the end of 2025, about 9.6% of student loan balances were at least 90 days delinquent. A separate measure tracking the transition into serious delinquency had also risen sharply. Those measures are not the same, but both show the strain that emerged as reporting normalized. This is where the story spreads beyond the loan itself. A missed student loan payment can be reported through the credit reporting system. A weaker credit profile does not merely change a number inside an app. It can affect access to or terms on future credit, such as a car loan, credit card, or mortgage, and it may also matter in some rental screenings. But the largest cost may appear on money the borrower has not even borrowed yet. Imagine two identical households. They earn the same income. They want the same car, but one household has a damaged credit profile after months of missed student loan payments. The car does not become more expensive at the dealership. The financing does. A higher interest rate turns the same object into a larger monthly payment. That larger payment leaves less room for groceries, repairs, childcare, savings, or an emergency. This is the hidden mechanism. Default can make future money more expensive. Then comes the second mechanism, direct collection. If a tax refund is intercepted, that is not abstract government accounting. For many households, a refund is the money used to repair a car, pay down a credit card, cover medical bills, or build a small emergency cushion. If part of a paycheck is garnished, the effect repeats every pay cycle. Again, this does not mean 9 million people lose 15% of every paycheck tomorrow. The point is that a growing group of borrowers has crossed into a system where involuntary collection becomes possible. Now multiply reduced flexibility across millions of households. That can mean delayed spending, reduced saving, or postponed decisions such as moving, replacing a car, starting a business, or pursuing more education. The exact macroeconomic impact is difficult to isolate. Student debt is not the only pressure on households, and higher-income consumers may continue spending normally. But the likely direction of the pressure is clear. For affected households, cash that might otherwise have gone to local businesses, housing, transportation, or savings can instead be redirected toward old education debt and collection costs. That is why this is not only a story about borrowers who failed to pay. It is also a story about the machinery around them. The United States spent years telling people that higher education was an investment in future income. The federal financing system then grew into a roughly $1.7 trillion student loan portfolio spread across tens of millions of people. Now, a significant defaulted portion of that portfolio is moving to the government's collection arm. There are still routes out of default, including rehabilitation or consolidation in qualifying cases, and borrowers need current information from official sources because repayment rules continue to change. But from an economic perspective, the important shift has already happened. The debt did not vanish during the pause. The consequences were delayed, and now the clock is moving again. As of March 31st, 9.57 million borrowers were in default, and another 2.97 million were delinquent. Treasury is taking a larger operational role, while credit reporting, offsets, garnishment, and the transfer itself continue on distinct implementation timelines. One missed payment looks personal. Millions of missed payments become a system.